Hello, Oracles. What is going on? What a day. I'm rushing around here trying to get dinner ready, and hope you guys were able to catch Brian's live stream to go over the numbers, because I'm going to pick Brian's brain about most of them. I only saw quick bits of it on Twitter as to basically seeing that we met expectations and haven't had a chance to dive into the numbers further. So we've got about 15 minutes, and we're going to dive into those right now for you guys before this earnings call. So, Brian, how's it going, my friend?
Oh, good. Typical earnings day. Right before the market closed, people started selling off because buy the rumor, sell the news.
Yep.
And they knew that next time the market opens, there's a good chance the price will be lower. What happened is Wall Street was expecting 85 pennies a share. It landed at 85 pennies a share. Oh, it's down in aftermarket. Of course it is.
Yeah.
We knew what to expect, and we hate it. And of course, you've already got all the big brains over at CNBC telling us why it's doom and gloom.
Oh, yeah. It was funny because I was just
predicted it, and it's doom and gloom.
Yeah, I was texting my dad about it, and you know, he's more of a swing trader himself. And I told him, I was like, going into this, I have a feeling we're going to probably meet expectations, but that's not going to be what the market wants, and they're going to sell off. And sure enough, he watches CNBC, and he's like, yep, there it is. He's like, they're all just dumping over there. They're like, oh, get out of there. And they're talking about China's costs are so high. And I'm like, yeah, at this point now, the market wanted to see the stock price come down, and we're going to see a lot of negative news coming in, and the FUD's going to go full bore. And I have a feeling that's what we're going to see.
That's about what happened. Now, the numbers aren't all amazing, but they're all pretty good. We knew that revenues would be up year over year. We knew that energy would be up. We didn't know it would be up this much.
Yeah. So I didn't even get a chance to look at energy. What was energy at?
So a year ago, it was at 600 million. This quarter, It was at 1.5 billion.
Nice. I had to forecast at 2 billion just because I knew they were growing. I just didn't know at what pace. So
right. You didn't know when the ramp in Lathrop got up to speed.
Right. Exactly.
And in the pre-show, I was answering questions from the Say Technologies investors. And one of them was, what kind of guidance are we looking at for energy storage revenue for the year? And I said, north of 5 billion, 5 to 10, probably closer to 5. And we are likely to smash through 5 by Q3 and come out closer to 7, 8-ish.
Yeah, that sounds about right.
And then next year it'll be even bigger because Mega Factory Shanghai will be online.
Yep, and Lathrop will be ramped.
Fully ramped, as fully as a Tesla factory ever is.
Yes. A mega ramping versus a giga ramping.
Well, it'll be at the point where you get incremental growth rather than double digit each quarter.
Yeah, right.
And so, it went. So that was the real shining spot there. Operating margin, down to 11.4, and that's the total operating margin.
Yeah.
So that is the lowest of the past year. The next lowest was Q2 of 2022 at 14.6. So that's maybe what they're looking at as a miss. But again, if you came out with 85 pennies, none of these numbers should surprise you.
Right. And I think what it comes down to also is Tesla met expectations for EPS, seeing operating margins down. I noticed, and I didn't see it, maybe I missed it, but I didn't see vehicle margins anywhere on the report when I quickly glanced at it, which they normally have it, and I didn't see it anywhere. So I'm wondering if they're just not even going to discuss it, because even in the last couple of quarters, you know, Zach came out when he was telling us, he goes, our focus is on operating margins and not vehicle margins. So I'm wondering if they pulled that out entirely just because it's not even worth looking at. But seeing as Tesla just dropped prices on the vehicles again last night on the Model Y, with people seeing these numbers coming in, seeing Tesla dropping the prices, they're just putting pieces together thinking that this is just going to mean lower margins all year long. And that's what we're going to be seeing all year long. And they're just going to be pricing that in.
Yeah, I'm not sure. Looking at on the report on page 21, there's a section where it shows operating margin compared to the rest of the auto industry, which has had some big quarters recently, getting up around 8%. And even this quarter, Tesla is still at 13% for operating margin,
Uh,
which is on par with the S&P 500 overall.
let's see.
Page 21 is where I was looking there. Is that right? Page 21.
21. 21. 23. 21. There we go.
That's the one.
All right. So what were we? So operating margin here. Yep.
Yeah. You can see the rest of the auto industry in gray.
Yep. Yeah, and that's the big thing too. And again, as we've talked about before, it's you're not paying your bills with automotive gross margin. You're paying it with operating margin. So even if your automotive margin comes down, but your operating margin stays strong, that's the most important part. And we're seeing it here. Based on the numbers, they're pretty even with the S&P 500, but still way ahead of automotive. So this again goes into that argument of why are we valuing Tesla like the automotive industry when they don't operate like the rest of the automotive industry?
Right. That would be like, a lot of McDonald's money comes from real estate. If we back that out, wait, why are we backing it out? Those are still real dollars, aren't
Right.
they?
Yeah, exactly. And not only that, but for Tesla, looking at the other pieces of their business, they haven't even really started pushing the energy or FSD or anything else that's coming out there. So that's top line numbers that haven't really hit. This is all them being able to operate significantly more efficiently just from the EV standpoint.
Now, that they've been spending money like absolute crazy, building in Shanghai a little bit, building in Berlin and Texas massively, Lathrop expansion, all of that. Cash on hand increased by $300 million. So they've got $22.4 billion cash on hand.
Yeah. And that's the most, and, going back to, points I've been talking about all year about, Elon voicing his opinion about, recessions and things. What do you do to protect yourself in a recession? Have a ton of cash, have cash flow coming in, and have no debt. And so they're just staying on track with that, waiting to weather this storm, because some people believe, and I'm one of them, that we haven't even hit the hard part of the storm yet. So, Tesla just doing what they feel is right to make sure that they're protected to get through this. And worst case is we don't get to a storm, and then they can deploy all that capital when we realize that we're, not going to hit it. But it's better to be safe on that end.
So I disagree that the recession is going to be much, much worse, but I am free to disagree. We have these assets ready to deploy in that case.
Yeah.
And what if another global catastrophe strikes? A lot of they were sweating bullets when they didn't know how long they'd be out of commission.
Right.
And rightfully so.
Oh yeah.
So
they are just giving themselves that safety net, and I am totally okay with that safety net. And so now Peggy was sent me a message before. He was noticing that there is a $400 million spread between GAAP and non-GAAP operating margins or operating profit. And he couldn't figure out why. And I hadn't had a chance to jump into the numbers. I don't know if you had noticed it or if you had been able to see what it was.
I hadn't, but that can be stock-based compensation. There's
I mentioned that
because that's not real cash, but it still has to be counted like cash. In the 90s, they did not count it like. I remember our CEO at Washington Mutual getting these huge bonuses, but they were all in stock. And I said, well, where do these show up on our balance sheet? And the investment guy at the desk next to me is like, oh, it doesn't. It just doesn't show up. I'm like, how does it not? Well, because it's not a cash expense. I'm like,
oh yeah, it's just swept under the rug. It's okay.
Well, it's not cash. We didn't spend it.
Yeah.
Yeah, but
and that was my thought too, is, stock-based compensation, but 400 million does seem like a lot. So, but I was like, there could be some other one-time expenses that came out also. I don't know if maybe they made another investment into something else. Like last quarter, I don't know if it was CDs or whatever they invested in last quarter. I can't remember. So I didn't know if there was something else like that was in there. I just hadn't a chance to dive in, but
The other surprise was, to me anyway, was a pretty substantial hit on foreign exchange. And
Yeah.
that might have been right at the top. I'm not sure, but I'm not sure. But yeah, there was a big hit.
Oh, sorry. They're coming on. We'll mute that for now. All right. All right. We're good.
Okay.
Sorry, that was the Tesla
Right.
earnings call music kicking in.
Right. Boy, for a tech company, could we get a phone system that wasn't made out of a couple of tin cans and a string?
Oh, I know. And here, Jay,
Page
maybe they bought more Bitcoin. Yeah.
page 5,
Oh, that's
financial impact of foreign exchange, 0.8 billion.
Yep.
Right there under revenue.
And now, with this being said, we know that China was still having a rough Q1, but we did see recently that China is making a very strong recovery right now in their economy. So, going forward, if China recovers nicely and the dollar weakens, that could actually turn around and be a positive impact in the future. So, it does go both ways. So, make sure you pay attention to that.
For sure. Let's see here. Yeah,
and yeah, Richard, definitely buying opportunity. This is one of the things I was talking about over. One of the things I was talking about over on Twitter was, my thoughts were, I have a feeling the market wanted it to come down. We'll probably bounce down to 160. I don't know if this is the signal of to fall further, or if we're going to react like Netflix did yesterday. Maybe we drop 5 or 6% and then bounce back up and recover entirely.
I was very surprised by Netflix's report. Revenue is up. Subscribers are up substantially. How can there be more people who don't yet know that Netflix has a wide variety of terrible selections?
I know.
There was a time when Netflix was it.
I know. Like one of my friends and I, like I'm a beach buddy coach, so we've shared passwords. So, we're basically just doing the same thing. I'm paying for one, she's paying for the other, but we're just, trading. And I was like, oh, what's on Netflix? I'm like, I've got Disney Plus, and everything I want to see is on Disney Plus. I go to Netflix. I'm like, what's this crap? I was like, everything I want to watch, I type it in and there's nothing there. It's like the Wish version or the valued store version of everything that I want to watch on there.
I searched up Tom Cruise, and I think there was one movie, maybe two. I searched Quentin Tarantino. There was, I think, just Reservoir Dogs is on there now. There's a whole lot of not very much stuff. Yeah. And in terms of anything owned by the Disney umbrella, the pickings are.
Yeah, and you're not going to get any of that. But it's like, I'm finding like Lord of the Ring-dings and Transformers. I don't know, man.
It's painful.
Oh, man. All right, we got 2 minutes. I'm going to jump and get this on the screen so we don't miss it.
Yeah.
There we go.
And Tim and I will be in the chat while it's playing if you wish to interact with us.
And I'll make it full screen. I know there's nothing to watch on there, but I will make it full screen. But I will be eating my dinner, so I will take us off of the screen so you don't have to watch me eat dinner. But
that's very kind.
Yes. Let me get volume back on here.
In the production capacity section on page 7, we still see Shanghai listed as, more than 750,000, which is a ridiculous understatement. It's 35% over that easily.
Oh, I know. Which
suggests that all the numbers could be overstated. I think the California numbers are quite accurate.
Yeah. Yeah. It's going to be mind-boggling when we start seeing Mexico's numbers coming out.
That ramp is going to be interesting to watch. And you'll see analysts saying, oh, no, they hit full capacity. That's not full capacity, my friend.
No.
And that's the thing is, with that 22 billion cash on hand, how much is it going to cost to build Giga Mexico? Giga Nuevo Leon could easily run 7 to 10 billion.
Oh, yeah.
Because it is going to be twice the size of Texas. And yeah, labor is cheaper, but is it that much cheaper?
Oh, I know.
I don't know.
We shall
Is
see.
it $5 billion cheaper? I don't quite think so.
I know, but still hearing the news that production is probably going to take a little bit, or construction is going to take a little bit longer than planned, is still fine. They're still going to have volume production hitting. I'm going to guess production we'll see is late Q3. Probably late Q3 of 2024, and then hitting volume production. But again, if it's going to be a whole new format of production, the learning curve is going to be there. So we have to remember the ramp up initially is going to be slow, but once they get it rolling, it's going to be hot. And once that gets rolling, when they open up another factory with the same format, that's going to hit the ground faster.
Yeah. And I wouldn't agree that it's going to take longer than expected. It's going to take longer than hoped, but they know what to expect, because
Right.
the 12 to 15 month number we heard is their expectation.
Right.
They would just they'd love to see it go a little bit quicker, but getting all your materials there months ahead of schedule.
And welcome to
would,
this first
Oh,
quarter
here we go.
2023 Q&A webcast.
Let me know how the volume is,
My name
guys.
is Martin Vieca, VP of Investor Relations, and I'm joined today by Elon Musk, Zachary Kirkhorn, and a number of other executives. Our Q1 results were announced at about 3 p.m. Central Time in the update deck we published at the same link as this webcast. During this call, we will discuss our business outlook and make forward-looking statements. These comments are based on our predictions and expectations as of today. Actual events or results could differ materially due to a number of risks and uncertainties, including those mentioned in our most recent filings with the SEC. During the question and answer portion of today's call, please limit yourself to one question and one follow-up. Please use the raise hand button to join the question queue. But before we jump into Q&A, Elon has some opening remarks. Elon?
Thank you, Martin. So just a Q1 recap. Model Y became the best-selling vehicle of any kind in Europe and the best-selling non-pickup vehicle in the United States. And this is in spite of a lot of challenges in production and delivery. So it's a huge credit to the Tesla team for achieving these great results. It is worth pointing out that the current macro environment remains uncertain. I don't think I'm telling anyone anything people don't already know, especially with large purchases such as cars. And while we reduced prices considerably in early Q1, it's worth noting that our operating margin remains among the best in the industry. We've taken a view that pushing for higher volumes and a larger fleet is the right choice here versus a lower volume and higher margin. However, we expect our vehicles over time will be able to generate significant profit through autonomy. So we do believe we're laying the groundwork here, and then it's better to ship a large number of cars at a lower margin and subsequently harvest that margin in the future as we perfect autonomy. This is an extremely important point. Let's see, regarding the Cybertruck, we continue to build alpha versions of the Cybertruck. A great delivery event, probably in Q3. As with all new products, it'll follow an S curve of, so production starts out slow and then accelerates. So the Cybertruck is no different. So there's a tremendous amount of demand for the product, obviously. And it is, in my view, a fantastic product, a Hall of Famer. But as with all new products, it takes time to get the manufacturing line going, and this is really a very radical product. It's not made in the way that other cars are made. So let's see. With regard to Megapack, we're making great progress. Our energy storage deployment reached nearly 4 gigawatt hours in Q1. It's by far the strongest quarter ever. And this growth was achieved thanks to the ongoing ramp at our mega factory in Lathrop, California. There's still some way to go to reach the full run rate of 40 gigawatt hours per year. And then we additionally announced the start of a new mega factory in Shanghai. So we were, as we've expected, the stationary storage growth actually will significantly exceed the vehicle growth. Regarding Autopilot and Full Self-Driving, we've now crossed over 150 million miles driven by Full Self-Driving beta, and this number is growing exponentially. This is a data advantage that really no one else has. Those who understand AI will understand the importance of data, of training data, and how fundamental that is to achieving an incredible outcome. So, we're also very focused on improving our neural net training capabilities, as is one of the main limiting factors of achieving full autonomy. So we're continuing to simultaneously make significant purchases of NVIDIA GPUs and also putting a lot of effort into Dojo, which we believe has the potential for an order of magnitude improvement in the cost of training. And Dojo also has the potential to become a sellable service that we would offer to other companies in the same way that Amazon Web Services, offers more web services, even though it started out as a bookstore. So I really think that, the Dojo potential is very significant. In conclusion, we're taking a view that we want to keep making and selling as many cars as we can. Despite this being an uncertain macro environment, this is a good time to increase our lead further, and we'll continue to invest in growth as fast as possible. Once again, I'd like to give a huge thanks to all Tesla employees worldwide for doing an incredible job again, and super appreciated.
Thank you very much. And Zach has some remarks as well.
Yeah, thanks, Martin. I want to start by congratulating the Tesla team for record vehicle production and deliveries. And I also want to congratulate our energy storage team for record volumes as well. There's three main points I want to make. First, automotive gross margin and operating margin reduced sequentially, but as Elon mentioned, these remain at healthy levels. In particular, automotive gross margin was impacted by a few factors since our discussion on the last earnings call, which include additional action taken in the second half of the quarter to improve vehicle pricing, and one-time items, most notably warranty adjustments on older S and X vehicles, as well as increased deferred revenue for certain Autopilot features as we transition technologies. Progress on vehicle cost reduction continued in Q1 with meaningful improvements on logistics and the beginnings of some commodity cost reductions starting to be realized. Per unit costs for Austin and Berlin improved as well, driven by record volumes. However, these factories still provide a margin headwind and will likely continue to do so until after we reach and stabilize at our intended volumes. Note that Q1 was our third quarter in our multi-quarter plan to move to a more regionally balanced mix of build and deliveries. As I've mentioned previously, this results in lower deliveries than production within a quarter due to a higher volume of cars in transit at the end of the quarter, and has an associated impact on quarter-ending free cash flows. This was particularly prevalent in Q1 for S and X as we begin exporting cars for international deliveries. Second, our storage business is starting to take shape, and this is exciting to see after many years of investment and focus. This business is growing as a percentage of the company's revenue and reached its highest level yet in Q1, driven by an increasing rate of deliveries for our Megapack products. We are also making progress on storage profitability, generating our highest gross profit yet in the quarter. Third, I want to reiterate the philosophy by which we are operating the business this year. Our approach is to grow volumes as quickly as possible in both our vehicle and energy businesses. We plan to continue to invest heavily into our future plans, which include the Cybertruck, next generation platform, in-house cell production, energy storage business, and our autonomy and AI-enabled products. And we plan to do this while keeping the business financially healthy and industry leading. To accomplish this, we need to remain focused on cost efficiency and working capital, and in particular, unwinding the strategic inventory buildup left over from the pandemic. I want to conclude by thanking the Tesla team again as well as thanking our suppliers and our customers.
Thank you very much. And let's go to investor questions on say.com. The first one is, what is the process to make auto pricing adjustments? What variables do you consider? How frequently do you review pricing?
Do you want to take that, Elon, or do you want me to take it?
My apologies, sorry, I was on mute. Yeah, I think this is not something that we can really talk about. It's just we do our best to evaluate the production output, macroeconomic conditions, and we make a decision. But it's unless it's something you'd like to add, Zach.
No, I think that's right. I mean, as a team, we review where we stand globally on a weekly basis, and certainly can't get into the details of the reasons why certain decisions are made. But it is something that's very actively managed by a subset of the leadership team.
Thank you. The second question is, do you still believe Tesla Energy will be bigger than auto? And when will you provide more formal guidance on Megapack and overall Tesla Energy?
Yeah, I should just clarify, like bigger than auto from the standpoint of like total gigawatt hours deployed. So it's possible automotive revenue may be higher, but gigawatt hours, I think will be probably higher with stationary storage. If you just look at what's needed to transition the world to a sustainable energy economy, there is more stationary energy storage needed than there is mobile energy storage. So, and we are seeing growth of our stationary storage well in excess of automotive. So that is in line with expectations.
Yeah, and on the guidance part of the question, and maybe Martin, we can combine this with the next question, which is on guidance for margins. Just have a single comment there. I think we will get to the point where we as a company provide guidance on the storage business. I say storage is a combination of both the Megapack business and the Powerwall business. Relative to total revenues of the company, it's still fairly small. And the business has a lot of volatility currently, both in terms of volumes as well as financials, just given the small volumes and kind of diversification of the customer pool there. But as this business grows and smooths out, I don't think we're that far away from it. I think including these volumes on our day 2 production and deliveries release is something that we'll start doing. And then we can talk more formally as a business about our expectations over the coming year. I think it'll be a few more quarters before we get there.
Thank you. The next question, as you said, was already answered. So let's go to the battery question.
Oh, sorry, just one other thing I wanted to mention on margin. While we're not providing specific guidance there, I mean, just to set expectations of where we think this business will go in terms of margins, probably generally in the ballpark of what we've seen historically on the vehicle business. We generally look to mid 20% gross margins for any program that we launch. And so we're not there yet on this business, but that's what we're working towards.
We're hopeful to get there later this year, but that's not a promise. That's an aspiration.
Thank you. The next question is, how well are 4680 cells meeting the expectations described on the battery day? How long will it be until the cells meet those goals? Drew?
Yeah, so on battery day, we established a cost down roadmap through 2026 across 5 areas of effort. There was the cell design we discussed, anode and cathode materials, the structural pack concept, and the cell factory itself. We've been making progress across all these aspects since then. For the cell factory, the Texas 4680 factory, we are partway through building and commissioning and installing and operating. Will be 70% lower capex per gigawatt hour than typical cell factories when fully ramped, in line with what we described on battery day. And we're continuing to further pursue densification and investment reduction opportunities in future factory buildouts like in Nevada. On the cell design, we're in production with not only the first generation tablet cell we unveiled on battery day, but a second, more manufacturable version in Texas today. On the cathode material side, we have a number of activities underway per the battery day roadmap. For lithium, our Corpus Christi lithium refinery breaks ground this May. Our goal is to start commissioning portions of the facility before the end of the year. The refinery uses the sulfate-free spodumene refining process with reduced process costs, no acid or caustic reagents, lower embodied energy, and actually produces a beneficial byproduct that can be repurposed in construction materials. We discussed all of these concepts on Battery Day. Same with cathode precursor. We've successfully demonstrated a lower process cost, zero wastewater precursor process that we described on Battery Day at both lab and pilot scale, and are in the detailed design phase for incorporating this technology into the front end of our Austin cathode facility. On cathode production, we are 50% equipment and 75% utilities installed at our new cathode building in Austin, with our goal to begin dry and wet commissioning this quarter and next quarter, with the target to produce first material before the end of the year. Structural pack, we saw big improvements with pack manufacturing with the 4680 cell and the structural pack concept, 50% lower CapEx and 66% smaller factory for the same output in gigawatt hours per year. We do believe structural as a concept is a good one. It's simpler. We'll continue to structurally load the cells and use the pack as the floor of the vehicle, while iterating the design to closer to B-level execution of this A-level architecture in future programs. And zooming out for the 4680 team, Q1 was all about cost and quality. We made significant improvements in both areas. On Texas, production increased 50% quarter over quarter. Through yields increased 12%, and Cato peak rate increased by 20%, and through yields improved by 20%. Altogether, the team accomplished a 25% reduction in COGS over the quarter, and we are on track to achieve steady state cost targets over the next 12 months. And going forward for the rest of the year, the priority one is yielding cost for the 4680 program as we steadily ramp production ahead of Cybertruck next year.
Thank you very much. The next question is, what do you anticipate 2023 automotive gross margins ex credits will be at the company's current pricing levels?
Yeah, I can start off on this one. This is a difficult environment to make a projection like this. There's a lot of macro uncertainty. There's also headwinds and tailwinds. And, this is basically a question I think that's asking about our viewpoint on where costs will go. And within costs, there's a set of costs in which we do control, a set of costs in which we're kind of subject to what's going on in the macro world. Within the bucket of things we control, the most of the cost down that we're working on is around ramping our Austin factory, stabilizing that, and then doing the cost optimization work once we get to our intended volumes there. And a part of the cost journey in the Austin factory is, as Drew mentioned, the 4680 cell, which is an input into our Austin COGS. And so, as the 4680 program improves over the course of the year on cost, as Drew mentioned, and then the non-cell portion of the factory improves, we see a pretty good trajectory in the Austin facility. A similar story exists in the Berlin factory. It does not have 4680 as an input, but for that factory, the journey to complete localization is still ongoing. And so over the course of this year, as volume increases, more localization occurs, we do see a good path to cost reduction in the Berlin factory as well. In existing factories too, we talk about this on every call, so I don't need to rehash it, but the expectation is that every existing factory improves all of their key metrics, and we continue to see the progress there. There's also a handful of other costs in which we have influence, but the philosophy here is that we're aggressively going across every cost bucket that we can. Within the world that we don't control, the two major costs there being logistics, which fortunately is moving in our favor. And I think our supply chain team has done a great job both on logistics optimization and taking advantage of reduced spot rates where they can. So thank you to our supply chain team. And then there's the commodities world, which has been a huge page point in our cost structure over the last, say, 2 years or so. And we're still kind of at the maximum of paying for commodities in our cost structure. It kind of maxed out in the second half of last year. We did start to see in Q1 a little bit of improvement. We think there'll be a little bit more improvement in Q2. But
lithium has dropped a lot. It's worth mentioning
Yeah.
that the price of lithium has dropped significantly.
yeah, and that's the piece that we expect to see more impact from in Q2. And generally, as a company, we do expect commodity prices to come down and have a more meaningful impact in the second half of the year.
Yeah.
So, this is our approach. How that nets out, I mean, just a lot of risk, and we'll have to see how the year progresses.
Thank you. The next question is, how has global order intake tracked since the most recent round of price cuts?
I think the overall thing we can say is that the orders are in excess of production.
Thank you. And maybe the last question from investors. Can you give updated specs and pricing for Cybertruck and any new features that will make it to production?
Well, I think we'll save that for the Cybertruck handover, which will hopefully be around the end of Q3 this year. And one thing I am confident of saying is that it's an incredible product. It's a Hall of Famer, I think. And a product like this only comes along once in a long while. So people will not be disappointed at all. It's amazing.
Great. Thank you very much. And let's go to analyst questions. We'll start with Alex Potter from Piper Sandler. Alex, go ahead and unmute.
Can you hear me?
Yep.
Yes.
Okay, perfect. So first question was on Lathrop. Obviously, it's great to see the growth there. Just wondering when you think that facility might be closer to full utilization. Are you just sort of deliberately working your way up the S curve there? Demand obviously isn't the limitation. So what are the steps, I guess, to unlocking full utilization there?
Sure. There are some classic, factory ramp aspects of what's going on in Lathrop. We actually have two phases of the CapEx there. We phased some of the general assembly parts of the facility. But in addition, we also have ramps with our suppliers that we are following. So both on the cell side and on the power electronic side. And we will see that unlock in the latter half of this year with both those inputs. So the overall facility was phased with the second phase of CapEx coming online towards the end of this year.
Okay, great. And then I guess my second question is on your ability to serve other markets out of Shanghai. Obviously, the facility in Berlin should be opening up your ability to, I guess, allocate more vehicles to Southeast Asia, Australia, other areas. I'm just wondering what other regions you think you're maybe not yet serving effectively. What are your timelines for addressing some of those gaps in your regional exposure? Thanks.
Yeah, that's a good question because there are still many parts of the world that we do not yet serve with respect to vehicles, especially. So we do expect to open up new markets around the world. And while those markets are not necessarily individually gigantic, they do add up to, if you add up a whole bunch of markets, they do collectively sum up to something significant. So it's high time that Tesla offered its cars to the rest of the world, and that is something that we intend to do.
Okay. Thank you very much. Let's go to the next analyst, George from Canaccord. Go ahead and unmute.
Hi, thanks for taking my question. I was wondering first if you could discuss your FSD take rates and whether you've seen any significant positive or negative change there. And also, given that you've reduced the prices for your vehicles, do you think you need to do that for FSD as well? Thanks.
Well, I'll decline to answer the details on the FSD take rate, but it's a tricky pricing question because the value of a car that is autonomous is enormous. So in a way, the price right now is an option value on an autonomous vehicle, and that value is that will ultimately be very, very significant. And it's really yeah, I mean, for those that are using the FSD beta, I think you can see the improvements are really quite dramatic. You know, there'll be a little bit of 2 steps forward, 1 step back between releases, and for those trying the beta, but the trend is very clearly towards full self-driving, towards full autonomy, and you know, I hesitate to say this, but I think we'll do it this year. So that's what it looks like.
Thank you. Maybe on the dramatic change we've seen in EV-related commodity prices, do you think it's a reflection of any recent overcapacity in mining and refining, or is that sort of a coincident indicator on global EV demand? And how do you expect those prices to kind of track over the next several quarters? Thank you.
And I wish I had a crystal ball to answer your question. I don't know if we can provide a question that would that would have any value really. I think we're in uncertain times, and if somebody's got a crystal ball they can lend me, I'd really like to borrow it. But you know, these are uncertain times. You know, my guess is it's, you know, economic stormy weather for about a year or so. And then it will hold roughly 12 months, and then, so this is my guess. It's just pure speculation. Stormy weather for about 12 months, and then, provided there are no major geopolitical wild cards that show up, things start getting sunny around spring next year.
The only thing I would say on the EV materials markets, they're not all super liquid, and some of them, for example, less than single-digit percentage of the market is actually traded on the spot market. So, and not only are they not super liquid, there's not storage isn't particularly facile for all of the materials. So small mismatches in supply and demand drive large price swings, not really real price swings, but just temporarily large price swings. So it's hard to read into those price swings. I don't know, Karn, if you want to add anything.
Well, but this is Karn, by the way. We are seeing, as Elon mentioned, quite a bit of softening in the lithium carbonate market. This was, 6 months ago, we were trading at $85,000 a ton, and today's spot price is about 26. So there's been a dramatic decrease in that. Of course, we were able to take advantage of low lithium pricing earlier on with fixed price contracts, and we find that this is going to be another opportune moment to basically extend that into the later half of the decade. But we at the quantities we're procuring, we're not as impacted by the spot market because we have those contracts in place, and we're just going to be going and doing more of that. The other thing that's happening is because of the price spike, a lot of the companies that are in this business are becoming more ambitious about finding more upstream resources and exploring locations in Africa as well as South America. So that's also helping the macro situation with pricing.
Yeah. But just on the lithium front, to reemphasize the choke point is much more on refining capacity than it is on mining. Lithium is actually is very common throughout the world, including in the US, and really it's just a very common element on Earth is lithium. So it's much more a question of where's the refining capacity, and can the refining capacity keep up? That's really what matters more than where is the lithium ore. It's everywhere basically. I think that same question also extends to refining of the cathode, and to some degree refining of the anode. And this is why we've at Tesla we're building our lithium refinery capability at Corpus Christi, and our cathode refinery outside Austin. It's worth noting, I hope other companies do the same thing. We'll have by far the most lithium refining capability and the most cathode refining capability in North America. I think probably more than everyone else combined, by a lot. So can other people please do this work? That would be great. We're begging you. we don't want to do it. You know, can someone please, like, instead of making a picture sharing app, please refine lithium, mining and refining, heavy industry. Come on.
It's fun. It's actually fun.
Yeah, exactly. It's real.
You have a customer. We're here, ready to buy.
Yeah, that's
right. I just want to emphasize, Tesla's not doing this because we want to do it. We have a lot of fish to fry, obviously, but we're doing it because others aren't doing it, and we wish others would do it.
Awesome. Thank you very much. Let's go to Emmanuel Rossner from Deutsche Bank. Hey, Emmanuel,
Hey, can you hear me?
Yeah, we can.
Yep. Perfect. Thank you so much for taking my questions. Maybe your first question for Elon on your pricing strategy. So if I understand your message, you're saying, Tesla feels it's worth maximizing the volume, increasing the size of the fleet as fast as you can, because you'll be able to monetize this over the life cycle of the vehicle. Can you be a little bit more specific around ways you would be able to monetize sort of like this existing fleet in the future? Obviously, I think autonomous seems to be a big piece of it. By my understanding was that Robo taxi would probably be for the next generation vehicle, not the existing one. So I guess in which ways would you monetize it?
Sorry, the Robo taxi terminology can be a bit confusing because that's sort of like a generic term for our next generation vehicle. And we obviously are working on next generation vehicle. It's going to be very compelling. This is just not the time to talk about it in detail as a product. So we internally call it robotaxi, but really all of the vehicles that have hardware 3, which is the vast majority of our fleet, we believe will achieve full autonomy. So there will be like a Model 3 or Model Y would be a robotaxi, a robotic taxi. So yeah, that's to the best of my knowledge that we believe the current hardware can achieve full autonomy.
Understood. And then maybe a question for Zach, back on the automotive gross margin. So I guess a few months ago, even after major price cuts, you felt pretty strongly that 20% automotive gross margin was still probably a reasonable floor. Obviously, the macro has gone worse, and additional price cuts have happened. Is there anything else that has changed in terms of the outlook? Is it just the macro deteriorating? Is it the competitive landscape? Anything else that sort of like makes you think differently around the full year? And is there a way therefore to frame a floor?
Yeah, about half of the miss against that previous conversation last quarter is attributed to adjustments we made in pricing in the second half of the quarter. I guess you could argue that lowers the floor in a sense. We've also made pricing adjustments so far this quarter, so that brings it down further. About the other half of the miss in Q1 was attributed to things that are non-recurring. So I mentioned these in my opening remarks. It's a warranty adjustment for cars that were previously produced, but not part of the pedigree of cars we're building now. And some autopilot related deferrals as we make some technology changes here that those deferrals should get recognized once some of the software catches up. So those two things are non-repeating. So hopefully that helps answer your question.
Yeah, I mean, there's really two macro factors that are tricky. The biggest being the interest rate. So if there's a very high Fed rate or interest rates are very high, that is every time that the Fed raises interest rates, that's equivalent to increasing the price of a car. It makes the cars less affordable because people are able to buy cars as a function of what they can afford on a monthly basis. So it's just almost directly equivalent to a price increase is any kind of interest rate increase. Then the other factor is whenever there's uncertainty in the economy, people will will generally postpone new capital purchases like a new car. So it's a natural human reaction. So if people are reading about layoffs and whatnot in the press, they're like, well, they might be worried about they might be laid off, so then they'll be naturally a little more hesitant than they would otherwise be to buy a new car. And now this is just the nature of the auto industry. But there will be a tremendous amount of pent up demand for new cars. So, but it goes through cycles.
Thank you. Let's go to Ben Kalo from Baird. Ben, go ahead and unmute.
Hey guys, Elon, when you talk about many fish to fry, you talked about Dojo being a product that you can sell outside Tesla. How do we rank all the things you have going on, and then in the economic environment? I mean, like heat pumps and everything else you have going on versus investing in the vehicle business. Or is that not the right way to look at it?
I'm not sure I fully understand your question, but I'd look at Dojo as like kind of a long shot bet. But if it's a long shot bet that pays off, it'll pay off in a very, very big way. Potentially, potentially in a very, very big way. Like, in the multi-$100 billion level. But the thing is, like, still put it in the long shot category, but long shot with a multi-$100 billion, potential outcome. And so it's a bet worth making, but not one you can sort of say like, oh, take it to the bank type of thing. Although these days, take it to the bank, it's maybe not as secure as it used to be. And obviously we're big believers in heat pumps, and that is on our list that, over time is to do a really good heat pump for homes and, commercial offices and stuff. And we have the technology, it's really good. But it's a back burner item. Our focus is very much on vehicles, autonomy, stationary storage, basically solving sustainable energy and solving autonomy, which would be like I said, solving autonomy. If we're able to have a fleet of several million vehicles that, with a software update, can be potentially worth several times their original value, that will be, if that happens, that will be and I think it will happen. That'll be the biggest asset value increase in history, I think.
Thank you, Bob. Just on pricing, a lot of pundits talk about the pie and losing share or gaining share, but how do you guys look at pricing versus the EVs or the ICE vehicles, or does that not come into the equation? Sorry to ask about pricing again. Thank you.
No, it's really just like, we're every day we get a daily real-time update of how many cars were ordered yesterday, how many cars were produced yesterday. We must have if there's a company that's got more real-time data than Tesla, I'm not sure there's any company on earth that has better real-time data than Tesla, except maybe SpaceX, Starlink. So because like we don't have to, for the other car companies, they will make the cars, send them to the dealers, then the dealers will sell the cars, and and then it takes quite a long time for them to get the data back to actually figure out how many cars were sold. Whereas we know how many cars were ordered yesterday throughout the world. So our fingers on the pulse is real time and does not have latency, whereas the other car companies have a lot of latency in their data, as does the government. The government has a lot of latency in their data. So we're just looking at and saying, okay, what does it take to achieve a clearing price for our vehicle production? And and then we make a pricing change and we see what happens immediately, and adjust course. So we're adjusting course, and we're thinking about it literally every day, 7 days a week. Every 7 days a week, I look at that email, and so does the rest of the team. And we try to make the least dumb decision that we can. And on balance, I think our decisions are pretty good. Sometimes they'll be, dumb, but on average, they're, I think, better than the rest of the industry.
But just to add on the question about EV market share or ICE, this comes up a lot. I think a lot of the public debate is around this concept of EV market share. We don't look at it that way. I mean, we look at it as market share of cars. It's the car market, not the EV market. And actually, the mission of the company requires internal combustion engine cars to be switched over to electric vehicles. So that's what we pay attention to.
Yeah, I said that last time too. You guys got to stop looking at it as the EV market. It's how many cars are we selling? Just start looking at it that way.
All cars will be EVs. It's it's gonna. I've said this for a long time. We'll look back. I don't know. Assuming civilization's still around in 20 years, we'll look back on internal combustion engine vehicles the same way we look back on external combustion engine vehicles, which like a steam engine. A steam engine is an external combustion engine vehicle, and there's still a few around. They're kind of quirky and kind of cool collector's items. That's how gasoline cars will be in the future.
Thank you. Let's go to Colin Rush from Oppenheimer. Colin, go ahead and unmute, please.
Thanks so much, guys. Can you talk a little bit about how much of the actual cost structure is variable, on these vehicles? And if you could give us a range on plus or minus the lithium cost within those contracted volumes that you're seeing.
Well, I think you have to. Again, we'd really love to have a crystal ball here, but we don't have it. Depending on what time scale you're looking at, most of the car is variable. So most of the car cost is variable. So, and probably, if I were to guess, I think we will see improved costs from suppliers. Yeah, I think we will.
Yeah.
That is our expectation.
And we're already starting to see that. Elon, I think you'd mentioned before that we anticipated a crash in the lithium prices, and some of that has flowed through by way of lithium carbonate reductions into battery cost. And the same thing will happen with lithium hydroxide. The length of the supply chain matters also, because what we're talking about is very far upstream. So by the time it makes it into the battery that's up in a car, it'll be several months. But beyond just the commodity pricing, as Zach mentioned earlier, we're also very focused on other metrics that make production very efficient. So, for example, detention and demurrage, air expedites. I think our air expedites are down 90%. Detention and demurrage is down 93% from the peaks. That can be hundreds of thousands of dollars per vehicle. So we're sort of attacking all vectors and becoming very efficient.
Okay. And then my follow-up is really around stationary storage demand on the utility scale. I mean, obviously there's a gigantic queue for interconnection in the U.S. And can you talk about the volume of quotation you're seeing at this point around stationary storage for that renewables queue on a global basis, and how much of that is converting into actual sales?
Drew, you want to take that?
I mean, I don't, that's also not exactly how we look at it, really. We're not we're not engaged in the interconnection queue. Like, we're focused on ramping Megapack as quickly and efficiently as we can. And we have, visibility into the pipelines of, a variety of different renewable energy and just pure stationary storage developers. And we also develop our own projects. And we're mostly just we're being selective and trying to pick the projects that best fit our mission and our objectives.
Yeah, this is not a product call, but we'll have something. I mean, we're making improvements on many fronts, including Megapack. So I think some of those improvements will improve the speed at which you can connect the Megapacks to the grid.
Thank you. The next question is from Mark Delaney from Goldman Sachs.
Yes, good afternoon. Thank you for taking the question. Do you still see 2 million units as an upside case for volume this year? And is the gating factor for reaching 1.8 million or 2 million units in 2023 still supply chain, as was mentioned on your last conference call, or is it more about demand at this point?
Well, you know, if you have a crystal ball, you can lend me back to the crystal ball situation. These are volatile times. From a production standpoint, if things go well, we've got a shot at 2 million vehicles this year. But that is the upside case. And we feel comfortable with 1.8. And we'll just have to see how this year unfolds.
That's helpful, thanks. And then the company has spoken at the Investor Day and for the past conference calls about opening up its vehicle charging network. Can you speak to some of the feedback you've been getting from both Tesla owners and non-Tesla owners, and how the ramp of the charging network may progress from here? Thanks.
Drew, you want to take it?
Yeah. So as you may have seen, we opened our first V4 post in Europe and our Magic Dog post in North America in Q1. And that is, indicative of the direction we're heading with, universal compatibility for all vehicles of, no matter where the charge port is, et cetera, in all major markets. And we're going to continue to roll out those sort of improved offerings as we build new stations. We're always balancing like our ability to serve our own customers with our ability to serve new customers when doing that. I think we've been able to balance it rather well. For example, in Europe, 50% of all of our supercharging stations are open to all EVs. And we've been able to do that without any increase in wait times at all for anybody. So we're going to continue to take a similar approach as we do this in North America and China over the coming quarters.
Okay, thank you very much. Let's go to Rod Lache from Wolfe Research.
Hi, everybody. I just wanted to first just follow up on your comments in your letter about leveraging your cost position as others struggle with unit economics, and also taking into account the lifetime revenue, actually in a way that most other automakers will never see, just given your service network and supercharging and other attributes. Can you just maybe give us a sense of how far you'd be willing to take this? Are there brackets around the range of initial margin that you'd be comfortable with? And again, any color that you might provide on the updated range of margins that you'd expect in the auto business?
I think we may have answered this question or tried to answer this question a few times, but it's difficult to say what the margin will be. It depends on what the macroeconomic environment is like, So, for example, if the Fed were to lower the rates, that would be super helpful for demand. If they raise them, that just raises the interest cost that buyers have to pay to buy a car, so it reduces affordability and therefore reduces demand. So it's, but if we look past, say, this year, or like could go, sometime next year, middle of next year or something, I think things are looking really, I think, like I said, we'll best throw if there's some, major geopolitical wild card that turns up. But in the absence of that, I think I would be very optimistic about middle of next year, end of next year.
And just to add to Elon's comments, just two other points. What's really important for us this year, in addition to just managing the day-to-day of the business, but is also investing in, as Elon mentions, what 2024 and 2025 will look like. And so, using the cash generated from the sale of products today and reinvesting that, this is very important for us. I think that what happens to margins over the next couple of quarters only matters in the context of what that means for our ability to reinvest into 2024 and 2025. And we have a lot of space before that becomes something that we have to revisit our investment plans. And so, we're planning to keep the business healthy. But I just want to caution folks about reading too much into what happens over the near term here, because we're very focused as a company on making sure that when we exit this macroeconomic situation, this company is positioned in the best possible way.
Yeah, exactly.
Just to elaborate on that point, though, the revenue, the long-term lifetime revenue that you're targeting from each vehicle is massive. So if you took that to the extreme, it would seem that you'd be comfortable with a relatively low initial margin. Am I
correct
misinterpreting that, or is that exactly right? And just,
that is exactly right.
Okay. And the normally in a recession, when consumers feel less financially secure, actually price elasticity deteriorates. Just based on your pulse taking of the consumer, do you have a view on elasticity of demand?
Well, I can't emphasize enough the whole just fundamental question of affordability. For most people, their ability to buy a car is a function of can they make the monthly payment or not. And so like I said, if interest rates are really high like they are right now, then in some cases people can't get a loan at all. So it's and I think probably banks are pretty not leaning forward in providing loans. I expect these days. So so that's but like there is quite a powerful story here when you going back to something that was alluded to a moment ago, or mentioned a moment ago, that Tesla is in a uniquely strong strategic position, because we're the only ones making cars that technically we could sell for zero profit for now, and then yield actually tremendous economics in the future, but no, through autonomy. No one else can do that. I'm not sure how many people will appreciate the profundity of what I've just said, but it is extremely significant.
Thank you. Let's go to Adam Jonas from Morgan Stanley.
Hi, everybody. So first, Elon, good luck with tomorrow's launch at Boca Chica. Break a leg.
We definitely we can't have too much luck in the rocket business, that's for sure.
Incredible. So now that you've gotten to know the Twitter architecture kind of intimately well over the past 6 months, what can you tell Tesla stakeholders about how an X.com or super app could be potentially accelerative to Tesla's business model?
Well, I don't know. I guess it could make it potentially make it easier to buy cars. But we are straying somewhat off topic here because this is
okay. All right.
Do I think there's some benefit? I think probably there's some benefit. Yeah.
I get it, Elon. So just as a follow-up on manufacturing, you're a student of history, and you'll know that back in 1913, Henry Ford introduced the moving assembly line in Highland Park, Michigan, and the price of a Model T, which had already, been undercutting cars around the time, fell another 70 or 80%, and hundreds of rival car companies went bust.
Yeah.
I'm wondering if history is repeating itself here, Elon, and that the recent pattern of cuts with you is way ahead of the cost curve compared to competition, or is this? It seems like it's a calculated strategy, not just in reaction to competition or changing supply demand in the market, but could we catalyze some Darwinian forces in the EV market?
Well, I mean, we're not trying to say take pricing actions in order to be deliberately undermine competitors or anything like that. We really don't think about competitors that much. We just look at, do people like our cars? How can we make the product better? Can they afford our cars? And the sort of the things like improving service and whatnot. But like I said, we do have this unique strategic advantage that we have. We're making a car that if autonomy pans out, and we think it will, where that asset is actually will be worth a hell of a lot more in the future than it is now. So it is technically possible to sell it at zero profit, but still have the net present value of future cash flows associated with that asset be very significant.
And service and charging and insurance and all of these other ongoing revenue streams that other companies don't have.
Yeah.
Certainly, we want all EVs to succeed too. We just want to say that we're not in like some malicious attack to try to just crush everybody.
Definitely not. We're like opening up superchargers. We've made our patents available for free. So it's like we're trying to be helpful here, So we're not out to just destroy competitors or anything like that. We're trying to help competitors, frankly, in any way that we can.
Thank you. Let's go to Dan Levi from Barclays.
Hi, good evening. Thank you. First question, you're ramping supply at Austin and Berlin. So I wanted to understand just how critical it is to further increase volume at those plants just to get the vertical integration benefits in the face of the sort of market with some demand questions. And just broadly, should we historically you've been operating at the pace at which your supply allows you to produce as opposed to gauging to demand. Should we generally expect that you're going to continue to produce at your whatever the max capacity that you're allowed within your supply constraints, regardless of what the broader economic environment is, just to continue to get that volume out there?
That is, yes. I mean, there could be like obviously a macro shock that is so severe that people just stop buying cars for some reason. But in the absence of that, we will continue to grow output at a rapid clip.
Great, thank you. And then just on the margins associated with Austin and Berlin, you mentioned Austin and Berlin have a margin drag until you reach intended volumes. I don't know if you can disclose what those volumes are. And maybe you could just remind us of what the margin profile of Austin and Berlin will look like versus Shanghai once you get the vertical integration benefits in place.
Well, probably won't be quite as good as Shanghai. Is hard to, has a very efficient cost structures. Obviously our lowest cost structure in the world. But we do expect to be make significant improvements in Austin and Berlin, and continue to make improvements in Fremont as well. So.
We've increased, this is Roshan, by the way, we increased our localization efforts. So that will then drive down our days on hand requirements. We've made 10% quarter-on-quarter, improvement in days on hand. So we'll continue that path as the localization improves.
Okay, thank you very much. And our final question comes from Philippe Bourgeois from Jefferies.
Yes, good evening. Thanks for taking the question. It's slightly longer term. I completely agree with your comments that we should look at Tesla in terms of auto market share, not EV market share. But I'm just wondering, as you build up the market share globally, is there a limit to the direct selling business model as you practice it? And should we think about going forward, you need to look into the agency or using importers to basically develop market share more smoothly, I guess, globally? And so in other words, is there kind of a sell by date for the direct business model as you practice it today?
Seems to be working well so far.
We hear different feedback from customers who miss the human interaction or unhappy with the service. And I'm just wondering if you're seeing some growth pains in there that would lead you to change. You're not seeing that.
Well, I mean, there are, since we're always going to have some growing pains where, at times, and it depends on which geography we're talking about, where sometimes service is behind sales. Sometimes it's ahead of sales. This is, Tesla's growing, I believe, faster than any company in history that makes a large, complex manufactured object. So, these are, if you're trying to max, it's always difficult to match exponentials. But I think it is helpful to have the feedback loop with service, because that means we feel the pain of service, and then we can adjust the design to make the car need less service. And I think that gives us the right incentive structure, because the best service is no service. The car doesn't break. And whereas if you have, say, a dealer network that is reliant upon service as a revenue, then you arguably have a misalignment of incentives, where they're making money on service, but actually we want to, the best thing for the consumer is the car doesn't need servicing. So,
yeah. And on that front, if I can follow up, have you worked out, for many of your traditional competitors, a fair amount of profits for them comes from selling spare parts and servicing, and you don't have that in your profit structure. And have you worked out how much of a deficit you have compared to your peers?
Yeah, actually, this one's something I could wax on about for a while, because really people didn't understand that the best short-selling argument against Tesla for the longest time was the fact that Tesla does not have an existing fleet, and that the auto industry, the reason incumbents succeed and newcomers fail, the biggest reason is that the incumbents have a large fleet, and they're able to sell new cars at close to zero margin, and then sell spare parts at a very high margin, sort of, razors and blades type thing. And so the only way to actually succeed, for a newcomer to succeed, is to have a product that is so compelling that people are willing to pay a premium over the incumbent product. And in the absence of electrification and autonomy, I don't think a newcomer can succeed.
Thank you very much, everyone. Unfortunately, that's all the time we have for this quarter. We'll see you again in 3 months from now. Thank you.
All right, let's get this over here now. That's gone. Let's do this. Pow. And then pow. And then
Pow.
get my audio back to good. All right.
Likewise.
So for those of you guys who are watching this after the fact, just so you know what you're missing in the live stream chat, it's a whole nother level of entertainment. So thank you guys in the chat, because you are a riot. And yeah, so if you guys want to enjoy that in the future, definitely hop onto the live stream if you can. So yeah, what'd you think, Brian?
Oh, I wasn't listening.
Oh, we'll give you a recap.
So there was I think it was a great call. I think for once, the Say investor questions were good. And for the most part, the analyst questions were good. And actually, the Say questions were better than the analyst questions. A lot of them were what we expected. A lot of them were non-answers. Those asking for Cybertruck updates, you're not going to get that today.
And at this point, just wait. You're going to know the answers within 6 months.
You're going to know it. He said Tesla's in a uniquely strong position to harvest margin in the future. And they are. There are other subscription services that other car companies have, but nothing like this, nothing close. If all your Fords are sold at no margin, the most you're going to get in the future is a few $100, maybe $1,000. It's unique.
Yeah. And
Big
that was
thing with, go ahead.
That was one of the things that I had mentioned a few months back, in the very little type of comparison you can make between legacy auto and Tesla is Tesla has a vehicle that they can sell at, zero margin and make profits in the future but the profits they're going to make on in the future are from things that are going to make the vehicle that much better versus legacy auto, who makes their money on the margins on the stuff in the future because they have to, and they have to make a vehicle that's not going to be as good because they need to rely on the parts and service in the future. Meanwhile, Tesla's like, we'll make you an awesome vehicle and we'll make it even more awesome in the future.
The one I'm looking up is Mercedes GPS map update price. Just to update it, you're talking $750 to update your GPS map. What are you talking about? That should be free.
Yeah, that should just be automatic. Hey, here's your, just like your iOS or your operating system update on your phone. Like, all right, here's your update, done. Like having to pay for it. Like, hey, by the way, all the roads in your area changed, but we're not going to tell you where they changed and what they changed to. You're going to have to pay for that. Like, what's that?
Apparently you can buy pirated ones for 40 to 100, but still, what a pain. What a hassle.
Man, but,
So
but you know, and you guys in the comments had great discussions as well. And it was something that I've been talking about for a while when Elon was talking about FSD and going, you know, potentially selling at zero margins, which is just that. I think in the future, seeing as we've spoken many a times about how, you know, a Tesla is basically a smartphone on wheels. Well, if we take that to the next level and think about, well, how do smartphones get sold now? You're basically purchasing a plan for your phone, and then you just kind of include the phone in that plan. So that's how you're paying for it. And that's basically what I think we're going to end up seeing in the future for Tesla is if you want to buy the car outright, awesome. But if you want to get FSD with it, you're going to end up paying for this plan. And the price of the car is just going to be lumped into that plan. And then, of course, all those extra add-ons you're going to have afterwards for whatever you want, you know, is just going to be another revenue stream in software for Tesla.
That is exactly the case. There was the thing about the price drops that the analysts seem to be overlooking. They look at it and say, oh, it's terrible. The thing they're overlooking is it does expand the market. It does keep the units moving, and it's possible to do it without losing money. They still have a margin. They still have a healthy margin.
Yeah.
And he was saying a lot of the commodity prices that we've seen falling are just starting to get into the actual supply chain. So that means there are, just from today, already price reductions this quarter being realized without making any changes except what you're paying for your goods.
Right. And even they said, you know, like with supplies and stuff and the commodities, they're still paying a lot more than they used to. So if the prices are coming down, they're still hitting these margins. Just wait till those prices for commodities come down to levels that they were at before. And even if they don't come down to where they were at before, they're still going to come down significantly. So, and then the big thing that I love that Elon said too, thinking about with the Fed and the interest rates being high is keeping demand down. And the moment the Fed pivots, that's going to end up bringing demand back up. Now, obviously, they're not going to drop like a rock. I don't think they are. But the more interest rates end up coming down, that will in turn bring demand back up again. So even if Tesla doesn't come back up on prices, it doesn't matter because the demand will go back up. And if the demand does come back up so fast that Tesla can't keep up with production, then they can come up with prices. And they're just positioned so well right now.
And it's bonkers to look at what the share price was 15 months ago when it hit its all-time highs versus now when we can see the execution is going exactly to plan.
Oh, yeah.
They are making more money than ever. They're moving more units than ever. This is an absolute buying opportunity in my view, not financial advice, because Tesla is loading the spring. Yeah. And there's only so much you can load it before there's only so many cranks on that jack in the box before that clown pops out.
Oh, yeah.
And that's what we're looking at and we're seeing it. It's in the numbers. It's right there. 1.3 billion in stationary storage sales. That's significant. That's a little bit of money.
Yeah.
And it's just getting started. So I did appreciate that he was careful to temper expectations between promises and aspirations. Everyone says, oh, Elon promised this. He doesn't do that. He doesn't do that. And he's even walking it back a little bit more than he has in the past, which is great. He believes, as he has always believed, FSD will be done this year because it's so close. He can taste it, but it remains impossible. We saw a Cruise fully autonomous car smack into the back of a bus.
Yeah.
Well, if only they had better sensors. They've got like 1,000 sensors on that thing, and it's still crashing into buses.
They should have put bumpers on it, like bumper cars, rubber.
Oh, yeah. Yeah. I mean, that bus knows what it did.
It shouldn't have stopped where it was. How dare you stop at a red light?
How dare you stop at a bus stop? Of all the crazy things.
But I agree. I do like how they kept this. And I've noticed the kind of this trend over the last few earnings calls is whereas, back in 2020, even early 2021, the enthusiasm was kind of a little overplayed. And not to say it shouldn't be, and I think the future is going to play out that way. But these were much more muted earnings calls with exactly like you said. The expectations weren't like, we're going to crush it. We're not going to the moon. And none of that stuff was there. This was hey, you know what? Just 1.8 million vehicles this year. 2 million is an upside, definitely an upside. And he reiterated that to ensure that that's an upside thought,
And you and I have thoughts on that. I'm sure you agree that 2 million is the low end.
I mean, I'm still at 2 million. I'm actually, I think for deliveries, I'm just over 1.9 for deliveries. So production, I'm right around 2 million. So I think, I think it's going to be there. It'll be close, but again, it's all going to come down to, just, they said they're just going to put out the vehicles like they can, but is the demand going to be there? And I think a lot may come down to interest rates. I personally think interest rates are going to go up one more time, 25 basis points, and then it'll be paused from there. But that's still going to be a high interest rate for the rest of the year to kind of put some pressure on deliveries.
Yeah. And adding another $70, $80, $100 to a payment is significant. The thing that's crazy to me with the lower prices is who on earth is going to buy any sedan other than a Tesla in EVs? The other cars might be close to as good for significantly more money. This is a lot of pressure on them to hurry up and get their production figured out in a way that will allow them to lower prices, because this is Tesla's world, man, and they're just playing in it.
Oh yeah.
I did appreciate finally hearing, because I've been saying this for a year, Robotaxi is not a physical product, it's a philosophy. It's they're all Robotaxis.
Yes, they're all going to be Robo, and there is going to be a specific platform that's going to be like that 6 or 8 seater type van thing that you'll see in cities going around. That will be the Robotaxi, but every vehicle will be a Robotaxi. And I'm glad that they asked that question, and Elon definitely came out and clarified all of that. So that was nice.
I'll tell you, the 6 to 8 passenger little van sounds boring. Tunnel. So I think that's what they're going to use there.
Oh yeah, it'll be there, and I have a feeling they're going to use it at stadiums for sporting events. They're going to use it at airports, things like that. It's ideal for those situations.
Yeah, I like the Canoe. Have you've seen it?
Oh yeah, yep.
My concern with it is that adorable flat front glass. You need Tesla glass on that, or just plan on replacing it twice a week.
Yeah. So one thing, going back to the margins and the interest rates, I thought about was, think about the timing of this. If we're going to have this next generation vehicle, the compact car, most likely around that $25,000 to $30,000 range, coming out end of 2024, beginning of 2025, hitting volume production most likely in 2025. If interest rates being high mutes demand, and interest rates coming down is going to bring demand up, with the timing of this, with the Fed coming down with interest rates over the next 2 years, at the same time that we're going to be hitting volume production on a lower priced vehicle, what do you think that's going to do to demand?
I don't believe that the first 100,000, even maybe 500,000 of those cars are going to be sold in the US. There might be some uber premium all-wheel performance version that comes in that's sold for 40, 50,000 to the early adopters. But I think that's going to go heavy into new markets where Tesla is interested in getting a foothold.
Yeah.
I
India
could be
could
wrong
be a
on
big
that.
one.
There's all of South America is ripe for disruption, and those countries need these.
Oh, yeah.
And they can't get them if they're even at 40,000. A lot of those markets will not be able to hit critical mass in a way that would allow them to build out the supercharger network and the service centers to support them, except in very limited areas. So that's going to be critical there. But if it does hit the US at the same time that interest rates come down, hold on to your butt, because they will move every single one of them as quick as they can build them.
Oh, yeah. And then to take it to the next level, think about fleets, think about Hertz and rental car companies and how much they're going to want to bring those in, because they can rent those out and make buco bucks on that kind of stuff. I mean, that's like the demand for that vehicle is just going to be mind-boggling. I mean, and they've said it before that vehicle alone is going to outsell every single vehicle that they have right now combined.
Wow.
And
yeah, absolutely. Absolutely. I did think it was nice to see that they talked about the cathode building in Texas, because as you know, I am the factory guy. And they're saying 75% built, 50% outfitted. It's right on pace. I've been saying should be operational by end of year, and I still think that is correct. But
no, I don't know if you had heard it, and I know Drew was talking about it, and somebody had asked in the comments about the lithium refining and when that's actually going to be viable and up and running.
I didn't catch the timeline on that. My internet booped out on me for a minute there, and I don't know why it never does that. But the big news I liked there is they're going to be using the waste material, reusing it, repurposing it, making bricks or whatever they can with it, and that's helpful. But it needs to come online around the time that they'll be ramping in Mexico, I imagine.
Oh, yeah.
So
and you guys can let us know if you saw, let us know. And I swear Drew had said 2024 they'd have it up and running, which makes sense, like you said, with timing of Mexico coming up online. So that would make sense.
Yeah. And in the chat earlier, Karav had said that the average selling price struck him as rather low, and it's 46,000. That doesn't strike me as low because of the sheer volume of units sold in China.
Yeah.
Where the selling price is the lowest. Lowest. Their Model Ys are selling at or below 46,000, and their Model 3s are selling in the mid 30s, I want to say. And based on just the sheer volume, that pulls it down for everyone. In 46,000, there was a lot of cars in other markets being sold under that price.
Yeah.
So
yeah, and so for me, I was guessing I had my valuation model at 46,000 for average selling price, and maybe 48. I was between 46 and 48, but I had factored in 46,000. It just made sense. And like you said, the majority of vehicles being sold over in China at that price, and then with the second half, the last month, my whole thought was the timing of Europe coming down on prices. How much would that factor in? And that was going to determine whether it was 48 or 46. And so it looks like, the amount that sold through over there pushed it down to 46. So,
and expanding in new markets, not just Thailand, but expanding into entire new markets. Elon even said there are a lot of markets that we are not yet serving, especially in automotive. And these price cuts will open up new opportunities.
Oh, yeah.
And the addressable market is the world.
Yep. And like you said, when it comes to places like South America, where they don't have the infrastructure that can support, massive EV fleets, that's like the epitome of perfect places for Tesla to go. Because think about here in the US, trying to retrofit our infrastructure to solar is a nightmare. Just like, think about it like Fremont. You're never going to get the same production out of Fremont that you're going to get out of a new factory. So if you go to a place like South America or some other third world countries where they don't even have an infrastructure whatsoever, for Tesla to just go in there and start from fresh ground is going to be so much better. And those countries could actually just thrive even better than some of the, first world countries do now, because they're going to be living on this new technology in the future.
Yeah, and it's awfully exciting. I should say, if you guys have questions, get them in the chat so we can answer them. Did you have any other thoughts on the call itself?
I appreciated how many they answered a lot of analyst questions. Like, there was a lot.
More than I expected.
Yeah.
Quite a bit more than I expected.
Yeah, I was very pleased with the amount of questions that they had answered there. And again, when they, were discussing how they come up with prices, I mean, I couldn't have answered it better myself. Obviously, there's different things and criteria that they wouldn't share with us, but realistically, you just, you look at the market, and for them, I think it comes down to, they're looking at, hey, we're producing this many vehicles right now, and where's our inventory at? And Karav had mentioned it himself, is, they probably play that balance all the time. They're looking at a lot of different factors, and the balance of, well, are we producing enough to meet demand? We are. Okay, cool. That's great. If inventory starts building up, they start formulating a plan of maybe we need to cut prices if it's building up. And then if demand or if production is outpacing demand, we'll let it ride and see how it goes. So it's obviously, like Elon said, a week to week thing. They're constantly looking at those emails on a daily basis, finding out what's going on to come up with those plans. And
I had a question in my comments yesterday where someone had asked, how do you think they look at it fairly often to determine when the right time for price cuts is? And my answer was, I'm sure they look at it constantly.
Oh, yeah.
Nonstop. And every time they'll pull a lever like pricing or colors, or they will track it as it happens. They can sit there and watch the numbers change.
Yep. And like Elon said, which is great, the data feedback that they have is awesome. And I don't know if any of you guys had watched the Joe Justice video from a long time ago discussing how they operate on the production lines. It's immediate feedback. And that feedback loop is so constant and instant for everybody there. That's why they can change on the fly as quickly as they do. And all of that information coming in is processed immediately, and they make those decisions. Meanwhile, you get Legacy Auto, who's like, all right, well, we have to wait and wait and wait. And I was like, all right, now we're going to make a change. Let's come up with a plan to formulate this change. Now we're going to go out here and, okay, we've come up with our plan. Now we'll make this change. But it's a massive production to just make that one little thing happen. And like Elon said, when it comes to, the insurance and everything, the best service is no service. So yes, I know service is a complaint for a lot of people, but think about it from the perspective that Tesla does everything. They're looking at this long term. They're not looking at, hey, let's put a Band-Aid on the service to make our service better. Let's solve this and figure out how to make a car that doesn't need service at all. And that's what they're focused on right now. That's the big stuff. And so, yes, they still need to obviously take care of it because they're not at that point, but they're focusing their efforts on the future to where they don't have to ever have to worry about service.
So John asked, do you think other OEMs vary prices that often and we just don't know because they sell to dealers? And I would say definitely not, would be my assessment, because the dealers would throw a fit. I imagine the prices are contracted prices.
Yep.
If you want to lower the dealer cost, please do, but you ain't raising it. The other thing with dealer costs is you'll find sometimes dealerships where they'll sell you any car on the lot for $500 over invoice. That's all we're making it. That's not all they're making. There's a ton of money on the back end where there'll be incentives, where they'll give them promo cars that they then sell at full price, even though they paid nothing. There's all kinds of silly shenanigans, but that's the whole philosophy of car dealerships, is silly financial shenanigans.
Oh yeah. I work in retail, so I know enough that when you're working with vendors, they're like, here's your price, but if at the end of the year you buy this much product from us, we're going to give you a 10% rebate at the end of the year for all of this. So there's all these different things that are getting played. So they're working on getting rebates and credits on all sorts of stuff. And if any of you guys actually know, and I, unfortunately, the guy I used to know who owned a Chevy dealership, I don't have contact with anymore. But like when you said about pricing, I'm wondering if they go quarter to quarter with pricing, because usually you see like the seasonal specials and deals that are going on. So I'm wondering if, like you said, that I have no doubt it is contracted prices. That has to be, because like you said, dealerships are going to lose their marbles if they don't. But I wonder if it's going to be a quarterly type thing or if it's a model year type pricing. If any of you guys know, share. But I have a feeling it's either quarterly or annually.
Yeah. Richard was asking,
Yep.
disrupt tire manufacturing industry with no air and replaceable tread wheels. So Elon was asked exactly this question on Joe Rogan's podcast, and he said it can't be done. Tire companies have been trying it for 100 years. The physics is not in your favor. The air inflated tires just work. They're lightweight. They're because the more mass you add to a tire, the more energy it takes to spin, the more likely it is to fly apart. It's something that doesn't appear to be a possibility based on the physics as we understand them.
Yes. And even if you went to a wheel like they use on some of these all-terrain stuff, which are, just solid tires whatsoever, the expense and the material needed is just not worth it to do those. Because that was one of the things I questioned about the Cybertruck. We've got some of the vehicles that we rent at work. We've got, what did we have? Some lifts that we rent out. And the wheels on them are like, they would look awesome on a Cybertruck, and they're just solid wheels. But you start running those on asphalt for 100, 200, 300,000 miles, it's just going to deteriorate so fast. They're made for running on dirt, off-road, sometimes on asphalt, but not that many miles.
Yeah. And just the weight of those tires would make them unsuitable for high speeds.
Yeah.
So it is unfortunate, but GM sold 2 Hummers last quarter
to customers or dealerships. No, they sold them to executives. That's who they sold them to. They weren't even sold to dealerships.
Maybe that would make more sense.
Yes, man. And I'm just like, I'm rooting for everyone to get this, because we're all trying to get this EV revolution. We know it's already on the move, but to move it faster. But you start looking at the next 2 years are going to be pivotal. Whoever's going to produce the most in the next 2 years are going to win. It's production and autonomy are the 2 biggest factors when it comes to the automotive market in the next 2 years. And unfortunately, nobody else is even close. And most of the legacy automotive makers aren't even working on autonomy anymore. Like Ford is sort of doing it, but everybody else is just waiting for a third party to do it. Like maybe NVIDIA will end up doing something that we don't know about. But like, that's it. And even then, it's not going to be a legacy auto. They're still going to be relying on third party.
Yeah. And I think NVIDIA stands as good a chance as anyone of cracking self-driving. But until it's done, it's not done.
Oh, yeah. And as Elon said, who has the data coming in that Tesla does? Like, nobody has that real world data coming in. They just don't.
Not anywhere close to it.
Nope. And Tesla has so much real world data coming in that they're actually even also creating the other stuff themselves through their whole programs, that they're creating real world data from the real world data that they've got to be able to create simulations to then further that.
Yeah. Yeah. Any
All right.
questions
We're going to get not financial advice. Should I buy the dip or wait? My answer always to this question, because I can't give financial advice and nobody ever should, is what is your thesis on the stock itself? That's it. And the thesis is, are you planning on how long do you plan on holding it for? Ask these questions. How long do you plan on holding it for? What do you think the price of the stock will be at that point? Do you think the return on your investment based upon today's stock price is going to be worth it? If you answer those 3 questions and it's going to be worth it, then buy it. And this is considered your dip. That's all.
So here's mine. If your time horizon is short, I can't give you advice. That's not investing. That's gambling. And I do not gamble. If your investment horizon is long, look at the fundamentals and ask yourself, will this company be worth, will it stock performance likely outperform the S&P 500 over your time horizon? And if the answer to that is yes, then buy. And if you're asking when to buy, I say dollar cost average. When you've got some money, that's when you put it in. If you put it all in at once, it's still going to, over time, probably do about as well. If you look at the fluctuations in market price of, say, Apple 10 years ago, 20 years ago, would it matter which day you bought it at relative to today's money? Not so much. But you've got a lot of opportunity, I think, to look at all those factors and reach your own conclusion. But unlike a lot of the professionals who give terrible, terrible advice, I don't give actual advice. I just ask questions and hope that you find an opportunity in there to answer them in a way that helps you.
Yep. And that's, some of the best guys you're going to see out there, guys and gals, are going to give you that same advice is, go do your own research. And if you don't know how to do your research or you don't want to do that yourself, there's a lot of people out there. Like I've recommended people go see Brian, James Stevenson, Troy Tesla, Karav. A lot of these guys have great numbers and information. They dive into it and look at both sides of the spectrum, look at bears and bulls. They can do the analysis for you that you can at least get that piece of information from that because they've proven themselves to be relatively accurate, and just go by that. Tesla is going to license everybody. In the future, when everything is autonomous, nobody's going to need a license.
Oh, they mean other manufacturers.
Yeah, no, I know.
Yeah.
That I knew it. Yeah. So that's talking about FSD. Yes. They're going to do that too. And as Elon said, they have no problems licensing out to other people. But could you imagine the day Mary Barra has to go, Elon, can we have your FSD, please?
I'll tell you what I think the price will be. The price is whatever the hardware costs, we'll sell it to you for that. And the software is not for sale. It's that we will charge the same price we charge our customers.
Yep.
So you can let us just charge them directly, or you can try to mark it up above that, and your customer will just come to us instead.
Oh, that's
so
brilliant.
It'll be something that you just layer on top of every other car maker who didn't get there on their own.
Oh yeah. No, that's brilliant, because then consumers will have to make that choice of, well, do I then buy a Chevy and pay more for autonomy, or do I just go buy a Tesla?
And if they're not marking it up, then, and it is, let's say $200 a month, let's say it's even $100 a month. If you've got GM is selling, 10 million, let's say they get back to 10 million cars, 10 million a year, that's, $100 million, $80 million a month that Tesla would be bringing in licenses.
Just from GM on FS.
Just from GM, and just on that 1 year of production.
Oh man,
it would be.
Oh, that's outstanding.
Right? Yeah.
Let's see what else we got in here, and then my battery's going to die, so we'll get off soon. But let's see. Brian is brutal. Yeah, you gotta tell it like it is, man.
Yeah.
But that's so true, and I think that's going to end up what's playing out. And I'm trying to figure out when these things are going to happen, just timing wise. And if Elon says FSD is going to be solved this year, hey, we'll wait and see. 2 weeks from now, it'll happen. But
it's always eventually it will be 2 weeks, which is true. Yeah. And I've got a bunch of stuff I need to get done today too, because I am going to be on the road for 3 weeks.
Oh, yes.
Starting Sunday.
Yes.
So
Brian's going on a nice tour. So it's going to be a good time for Brian.
Yeah. If you're in the UK, I'll be speaking at Fully Charged in Farnborough, England on the 28th.
Yes. Actually, several people on here are from the UK. So, and I know it's late over there, so you may not be on now. So I will try to reiterate this on my next video to let you guys know that Brian will be in the UK. And if you want to visit him, definitely reach out, because I know lots of you guys are from there.
Yeah. And also Ireland. I'll be in Ireland more than England. So,
nice.
See. Yeah.
Awesome. Well, at this point, we're going to let you go, Brian. You've got things to get done. It's getting late over here as well. What an awesome... Oh, here you go. From the UK.
Yeah.
There you go. Brian will be there. Check him out. Yeah. So thank you guys so much for hanging out with us on this earnings call. Brian, thank you so much. If you do not follow him, check out his channel, My Tesla Weekend. Awesome information over there. Otherwise, you guys are awesome as usual. The chat comment was the absolute best. Thank you guys so much. We'll see you later.